Ready to learn about RV loans? Well, you came to the right place. Welcome to HBRV Lifestyle. They call me the Honey Badger because I give it to you straight in the RV business as always. And we're going to do a very simple video on how the basics of RV loans work. Now, get yourself a piece of paper and a pen. Make sure that you watch the entire video, otherwise you're going to miss out on something. Ready, set, and if this is the first time that you have visited this channel, I have over 13 years of dealership experience. I've done every job from cleaning them, to working on them, to selling them, to being a finance manager and getting loans for them. That was actually my forte and is still my forte today. So let's get started. Number one, we need to talk about the terms of the loan. There's a lot of fake information out there that there are 20-year loans on every single RV. So let's clarify this. There is 10-year, 12-year, 15-year, and 20-year terms. And what determines that length of the loan has to do with the dollar amount financed. Here's a quick example. There is a particular trailer that gets marked down to $15,995. If it's a $16,000 trailer, you cannot get a 20-year term. So generally, anything over $10,000 up to $20,000, and in some cases, $24,999, you can get up to a 10 to 12-year term. Now, if you go $25,000 and up, you can get up to a 15-year term. And then everybody's favorite, the old 20-year term, you have to finance over $50,000. Now, there are a few exceptions. And in those exceptions, if you go in the description box below, I put a playlist of all of my finance videos down there at the bottom. So make sure you check that out at the end of the video if you want more details. Now, what determines the term also is determined by your credit score or your credit rating. If you are someone who is considered subprime, you are probably going to get a max loan term from 10 to 12 years, sometimes, occasionally, 15 years. But if you are in that credit score that is under 720, you are more than likely not going to qualify for a 20-year term on an RV. Now, has it happened? Absolutely. This is just the basics, folks. So if you're in between, let's say a 670 and a 719 or a 720, you're probably working with a 12 to 15-year loan max. If you're working with a credit score under 670, you're probably between 10 and 12-year term max. So now we went over the terms, let's go over how interest rates and down payments go. This is where mass confusion comes into play a lot of times. A lot of folks associate lending based on the auto industry. Now, the auto industry works a lot different in how they configure down payment and interest rates. First off, in a lot of cases when you're buying a brand new car, there are rebates involved. And rebates get accounted for on a contract as down payment. So a lot of times you can put zero cash out of pocket, but maybe there's a rebate that's covering your sales tax and license fees. So in reality, you didn't really put zero down. The factory put money down for you, or maybe the dealership had some kind of down payment assist program through the manufacturer of the car. So in a lot of cases, all of these loans are not really pure zero down. Now in the RV world, the norm, now there's exceptions, guys, so don't get too mad at me in the comment section. There is exceptions to the rule. But in general, no matter if you're an 850 score or 550 score, the bank wants you to have a minimum of 10% cash down or equivalent in a trade or trade equity. Now, there are exceptions. I've repeated that probably 3 times already, maybe 5 times. I've lost track. And when it comes to zero down, a lot of times banks put a cap on the amount. For example, if you're buying a $35,000 travel trailer, your chances of getting zero down are much greater than if you are buying a $100,000 fifth wheel. So usually they cap the amount somewhere between 25 and 50 grand, depending on the bank or the credit union that you work with. And a lot of folks go, well, I'll just go to my credit union, they'll do zero down. In some cases, they will. But most of the time, their recreational lending practices are completely different than when you bought your car or your truck. Credit unions base their interest rate on FICO score and also the term of the loan. So the longer the term, the higher the interest rate. The lower the term, the lower the interest rate. So if you take a 5-year term at your credit union, you're more than likely going to get a better interest rate than if you take a 15-year term. But the downside is they cannot do a longer term than the prime banks that are used by dealerships. Most of the time they cap you at 10 to 12 years. And there are exceptions, credit unions I've worked with for the last 12 years that will do 15-year terms. But if you're looking for a 20-year term, the real only place you're going to find that is at the dealership lot. So when the banks are going to give an interest rate out, the term almost has nothing to do with it. You pretty much, with a few exceptions, wait, I've said that 6 times, will base the interest rate. The interest rate will be the same whether you take a 5-year term or a 20-year term, a lot of times. In some cases, some banks will give you a lower interest rate the longer term you take. But these are the 3 things. Make sure you write this down. The 3 things that affect an interest rate with good credit is number 1, the dollar amount financed, which means if you're gonna buy a $200,000 diesel pusher via used or new, well, there's no real new diesel pushers at that price, but say Levy, you're gonna get a better interest rate than if you buy a $20,000 trailer. You are also going to get a much better interest rate if you purchase new than if you purchase used. The second way a bank determines your interest rate is by the percentage of down payment. So if you put the minimum, which is 10%, or you happen to be one of those folks that gets zero down, you're gonna pay a lot higher interest rate than someone that puts 20 or 30% cash down. But there's balance, right? So we talked about you don't want to put too much down, but you want to put a good percentage down if you want that actual bottom line interest rate. And number 3 is your credit history and your score. This is where there's a misconception. So a lot of banks use a tier system based on not only your FICO score, but also your history. Has this been helpful so far? If it has, please let me know in the comment section. And if you enjoy the transparency, please make sure you hit the like button and subscribe to the channel. Now, the confusion among credit history critics is, well, I pay cash for everything, so I should be able to get an RV loan. That's not the way the bank looks at it. They want to see long-term established installment loans. Now, the definition of an installment loan to a bank is not a credit card. It is car loans. Now, you can also have a mortgage, but they also not only look at your mortgage, but they also look at your car loan history. By the way, credit unions work identically. The reason being is the bank thinks that you need the car to go make money. So they know that, well, at least in their mind, they know that you're going to get in the car and go to work and make a paycheck. The camper or the travel trailer, toy hauler, motorhome, etc., is vacation time. That's like buying an airline ticket way in advance to go enjoy a Hawaii vacation. I'm not really sure if that analogy works, but they don't want you to take out a car loan for 3 months and pay it off. They want to see some kind of history. They want to see like 2 years of payments on that car. Recently, just had an incredible family that showed up on the lot. They got a good amount of money down and they have 800 scores. And I can't get them a loan because they haven't had anything in a car loan or a home loan. They simply just have 8 or 9 credit cards that they keep very low balances on. And the maximum loan I could get them through a credit union was around $20,000 because they're in their mind, they're first time anything buyers, even though they have money and they have an established good FICO score. But then I had a nurse that walked into one of our locations and she carries a lot of credit card debt right now because I think her son or husband, I can't remember off the top of my head, is starting a company of his own and she wants to be supportive and help him out with that. So she's carrying a little extra debt, but her car loan history, she never takes the loans out for the whole term. She pays them off within half the time, and her FICO score was in the low 600s, and it was like watching piranhas on a feeding frenzy. Somebody's gonna get that loan. We got to fight over that loan. That lady pays her bills and she pays off her cars in 3 years. We love her. An 800 score that never had a car loan, they go, nah, we're good. So you just have to think about those things. The other part of credit history has to do with what kind of dollar amount we can get on a loan for you. We just talked about a credit union approving like a $20,000 loan for somebody that has never had a car loan before or even a lease. Well, let's talk about those higher dollar amounts real quick. But let's say that you want to get a $100,000 fifth wheel loan. Generally, a bank wants to see some kind of car history where you've made a $60,000 or $70,000 loan on a vehicle. Like if you bought a truck that you financed $65,000 or $70,000, they are more than likely going to give you that $100,000 loan than if you've only had, let's say, a $30,000 or $40,000 car payment. Now, in some cases, in a lot of cases, and I'm gonna say in probably 80% of the cases, if you have a mortgage in combination with a couple of past $40,000 or $30,000 car loans, they are more than likely gonna approve you for that $100,000 loan. So make sure when you're shopping and you know you're gonna purchase something, whether it's new or whether it's used, look at your credit report and look at your highest amount you've ever had financed. And then let's say it's $20,000, you should shop for something between 35 and 40 grand. Because if you shop for something that's 100, the bank more than likely, or the credit union more than likely, is not gonna approve that loan. They're gonna tell you, hey, look, great, but you need to build up to it. You need to build up to 100 grand. So let's talk about what subprime looks like and how interest rates look in this environment here in 2023, moving into 2024. And the most sensitive subject, I'll call it, is rates. Because most folks are not really happy about what's going on in the Fed and the government and blah, blah, blah. But here's what it is. If you have outstanding credit or good credit, rates are gonna be in the 8s to 10% range. It depends on how much you're gonna finance, how much down. When it comes to middle tier credit, and I'm talking that 670 score up to, like a 719, and again, exceptions, we've talked 7 times about that. The rates are gonna probably be between 11 and 15%. And then for anybody under 670, your rate's probably going to be between 16 and 19%. Pretty much right now, we're in the day and age where a double-digit interest rate is normal. And if you go back to the 1970s through the early 2000s into the mid to late 2000s during the Great Recession, we have seen swings like this, especially when they're trying to get inflation down. And for tips on that, make sure you click on that video right there.